In December 2024, the United States national debt stood at $35.5 trillion, a figure so vast it defies human comprehension. Hidden within this number lies a $72 trillion time bomb that few Americans understand. The combined exposure of foreign debt holdings, domestic obligations, and the implicit guarantees that underpin the entire system. For decades, foreign nations lined up to purchase American government bonds, treating U.S. Treasury securities as the safest asset on Earth. But something fundamental has shifted in the architecture of global finance. China reduced its Treasury holdings by $281 billion between 2022 and 2024, while Japan's purchases have slowed to a crawl. This isn't just about numbers on a spreadsheet. This is about the invisible foundation beneath American prosperity, a foundation that has quietly begun to crack. When foreign nations stop buying U.S. debt, the mathematics of empire change overnight. Throughout history, reserve currency status has followed a predictable pattern of rise, dominance, and inevitable decline. The nation whose currency the world trusts becomes the nation whose currency the world holds. This privilege allows governments to borrow beyond what their economies could otherwise support, financing wars, welfare states, and deficits that would bankrupt any other country. The mechanism is elegant in its simplicity. When foreigners need dollars to conduct international trade, they must accumulate dollar-denominated assets, primarily U.S. Treasury bonds. This creates artificial demand for American government debt, allowing Washington to borrow at rates far below what the fundamentals would suggest. Economists call this benefit seigniorage, the profit a country makes from printing money that others want to hold. But reserve currency status carries a fatal flaw embedded in its very structure. The more the world demands your currency, the higher your currency's value rises, making your exports uncompetitive and forcing you to run perpetual trade deficits. You must continuously supply the world with your currency, which means continuously running deficits, which means continuously accumulating debt, until the day comes when creditors question whether you can ever pay it back. As of 2024, foreign entities held approximately $9.1 trillion in U.S. Treasury securities, representing 30% of all publicly held federal debt. Japan alone held $1.06 trillion, while China maintained holdings of $700 billion despite years of gradual reduction. These nations aren't making charitable contributions. They're making calculated decisions about where to store their national wealth. The framework reveals an uncomfortable truth. Every reserve currency in history has eventually lost that status. The transition from trusted global currency to just another national money supply has never been smooth. The only question is whether America's turn will follow the historical pattern, and what that pattern looks like when examined closely. The British pound sterling offers the most instructive parallel to America's current situation. In 1945, Britain emerged from World War II victorious but financially devastated, holding debts that exceeded 180% of its gross domestic product. For decades, the pound had served as the world's primary reserve currency, but the war had hollowed out the economic foundation that supported that status. British authorities faced the same dilemma that confronts American policymakers today: how to maintain international confidence while servicing enormous debts. They chose to defend sterling's value through a policy called imperial preference, essentially forcing Commonwealth nations to continue holding pounds and conducting trade in British currency. By 1950, more than 55% of global foreign exchange reserves remained in sterling, a figure that seemed to validate the strategy. The illusion shattered throughout the 1960s. Britain ran persistent balance of payments deficits, importing more than it exported and paying the difference by promising future payment in pounds. International investors began questioning whether those promises held value. In November 1967, Prime Minister Harold Wilson announced a 14% devaluation of the pound against the dollar, reducing its value from $2.80 to $2.40 overnight. The 1967 sterling crisis demonstrated how reserve currency decline actually unfolds. It doesn't happen in a single catastrophic moment. It occurs through a series of increasingly desperate measures to maintain confidence. Britain implemented currency controls, restricting how many pounds citizens could convert to foreign currencies. The government negotiated emergency loans from international institutions, pledging future reforms in exchange for immediate liquidity. Each intervention bought time but eroded credibility. By the mid-1970s, sterling's share of global reserves had collapsed to less than 5%. The transition from dominance to irrelevance took approximately 30 years. An entire generation watched Britain's economic might evaporate despite desperate attempts to preserve it. The comparison to America's situation carries eerie precision. Just as Britain emerged from World War II with crushing debts and a determination to maintain its currency's international role, America emerged from the 2008 financial crisis and 2020 pandemic with debts approaching 130% of GDP and an unwavering commitment to dollar dominance. Just as Britain faced creditors who began questioning repayment capacity, America now faces foreign holders who have started reducing their Treasury positions. On August 15, 1971, President Richard Nixon severed the dollar's final link to gold, suspending convertibility and effectively ending the Bretton Woods monetary system established after World War II. This decision, taken without consulting America's allies, demonstrated that even the world's dominant economic power could not escape fundamental mathematical constraints. When foreign central banks began demanding gold in exchange for the dollars they held, Nixon chose to change the rules rather than drain Fort Knox. The Nixon shock proved that promises made by reserve currency issuers ultimately rest on faith, not mechanisms. For 50 years after 1971, that faith has held, sustained by America's economic dynamism and the lack of credible alternatives. But faith is not physics. It can evaporate far faster than it accumulates. The current American debt situation has reached dimensions that would have been considered science fiction even 20 years ago. The federal government spent $880 billion on interest payments alone in fiscal year 2024, more than the entire defense budget and more than Medicare spending. By fiscal year 2025, interest costs exceeded $970 billion, representing 19% of all federal revenue, meaning that nearly $1.05 collected by the government goes purely to servicing existing debt before a single road gets paved or soldier gets paid. Foreign appetite for U.S. Treasuries has entered a structural decline that data makes undeniable. Between December 2020 and December 2024, total Treasury securities outstanding increased by $7.2 trillion, yet foreign holdings grew by only $1.2 trillion. This means foreign entities absorbed less than 17% of new debt issuance during a period when they historically would have absorbed 30 to 40%. The composition of foreign holdings reveals an even more troubling pattern. China reduced its Treasury holdings by $50 billion in 2023 and another $57 billion in 2024, continuing a multi-year trend of gradual withdrawal. Chinese holdings peaked at $1.3 trillion in 2013 and have declined by more than 40% since then. This isn't panic selling, it's strategic repositioning, which makes it more significant precisely because it's deliberate. Japan remains the largest foreign holder at approximately $1 trillion, but even Tokyo has shown signs of reducing its exposure. Japanese purchases of new Treasury issuance have slowed dramatically as domestic interest rates finally rise after decades near zero. When Japan needs to attract capital to fund its own government debt, it can no longer automatically recycle trade surpluses into Treasury purchases. The Federal Reserve has inadvertently highlighted the problem through its quantitative easing programs. Between 2008 and 2021, the Fed purchased approximately $4.5 trillion in Treasury securities, effectively monetizing government debt by creating money to buy bonds. While this kept interest rates artificially low, it established a dangerous precedent. When foreign buyers won't purchase debt at acceptable rates, the central bank simply prints money to do it itself. In 2024, rumors circulated that Saudi Arabia had allowed a 50-year petrodollar agreement to lapse, potentially ending an arrangement where Saudi oil sales occurred exclusively in dollars. While fact-checkers disputed whether a formal agreement existed, the underlying shift is real. Saudi Arabia now accepts payment for oil in Chinese yuan, euros, and other currencies. The petrodollar system, which created structural demand for U.S. currency since 1974, has begun to unravel. The BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include Iran, Egypt, Ethiopia, and the United Arab Emirates, have explicitly discussed alternatives to dollar-based trade. In 2023, these nations represented 42% of global population and approximately 36% of global GDP. While creation of a unified BRICS currency faces substantial obstacles, the mere discussion signals that dollar dominance no longer seems permanent to major economic powers. Argentina and Turkey have negotiated bilateral trade agreements using their own currencies rather than dollars, despite both currencies being notoriously unstable. The fact that even economically troubled nations seek to escape dollar dependency indicates how widespread the impulse toward de-dollarization has become. When nations facing their own currency crises still prefer to trade in non-dollar currencies, the message is clear. Dependence on the dollar itself is viewed as a strategic vulnerability. Perhaps most significant is the behavior of ordinary investors and institutions within the United States itself. In 2024, domestic mutual funds held nearly $8 trillion in Treasury securities, while U.S. banks held approximately $4 trillion. This means American institutions have become the Treasury's lender of last resort, absorbing debt that foreign buyers no longer want in previous quantities. But domestic buyers face constraints that foreign central banks do not. They demand returns that justify the risk. They compete with other investment opportunities, and they can lose confidence just as easily as foreign creditors. When foreign nations reduce Treasury purchases, three mechanisms activate simultaneously, each reinforcing the others in a feedback loop that becomes difficult to escape. The first is the interest rate spiral. With less foreign demand, Treasury yields must rise to attract domestic buyers who have other investment options. But higher yields mean higher interest costs on the $35 trillion debt pile, which means larger deficits, which means more borrowing, which means even less foreign interest, a vicious circle that can accelerate rapidly. The Congressional Budget Office projects that, under current policies, interest costs will reach $1.7 trillion annually by 2034, consuming over 25% of all federal revenue. This projection assumes interest rates remain relatively stable. If rates spike due to reduced foreign demand, the trajectory becomes catastrophic. Every percentage point increase in average interest rates adds approximately $350 billion to annual interest costs within a few years. The second mechanism is currency devaluation. When foreigners sell existing Treasury holdings or simply stop buying new issuance, they must sell the dollars they receive in exchange for other currencies. This selling pressure weakens the dollar's exchange rate, making imports more expensive and stoking inflation. The Federal Reserve then faces an impossible choice: raise interest rates to defend the currency and risk recession, or keep rates low and accept accelerating inflation. The historical precedent is unambiguous. When Britain faced similar dynamics in the 1960s and 1970s, it resulted in the phenomenon economists labeled stagflation, simultaneous stagnation and inflation that contradicted prevailing economic theories. Britain's GDP growth fell below 1% for extended periods, while inflation exceeded 20%. The social and political consequences included widespread strikes, the three-day workweek of 1974, and the near collapse of civil order that brought Margaret Thatcher to power in 1979. The third mechanism is fiscal constraint. A government that can't borrow affordably must either dramatically cut spending or dramatically raise taxes. Given that interest payments, Social Security, Medicare, and defense spending together already consume nearly all federal revenue, meaningful cuts would require politically impossible choices: telling retirees their benefits will be reduced, telling service members they won't be paid, or telling bondholders they won't receive full interest. Tax increases face mathematical and political limits. The United States could theoretically tax the wealthy at confiscatory rates, but even seizing every dollar of wealth from American billionaires would fund the government for less than 9 months. The tax base required to close trillion-dollar deficits doesn't exist without impoverishing the middle class, and voters tend to remove governments that impoverish them. Some economists propose that the Federal Reserve could simply continue buying treasuries indefinitely, effectively printing money to finance government operations. The Weimar Republic tried this approach in 1923. By November of that year, $1 US equaled 4,200 billion marks. German citizens used banknotes as wallpaper because buying wallpaper cost more than using money itself. The hyperinflation destroyed the German middle class and created the political conditions that brought Adolf Hitler to power a decade later. Modern proponents of unlimited monetary expansion argue that the United States differs from Weimar Germany because the dollar serves as the global reserve currency. But that's precisely the status under threat. If dollar holders worldwide concluded that the Fed would print unlimited quantities, they would dump dollar-denominated assets immediately, triggering the exact collapse that printing money supposedly prevents. The geopolitical implications extend beyond economics. American military presence in more than 700 bases across 80 countries depends on the ability to borrow trillions at low rates. Reserve currency status is force projection status. Lose one, and you eventually lose the other. When Rome debased its currency in the 3rd century, the legions stationed on the frontiers soon went unpaid, and the frontiers soon collapsed. China understands this dynamic perfectly. Beijing doesn't need to match America's military spending dollar for dollar if it can undermine the financial foundation that supports that spending. Every yuan-denominated oil transaction, every bilateral trade agreement that bypasses the dollar, every treasury bond sold by a Chinese institution, these are moves in a financial chess game whose end game is the end of American primacy. The conventional narrative suggests that foreign nations need U.S. treasuries as much as America needs foreign buyers, that the relationship is mutually dependent and therefore stable. This narrative is comforting and dangerously wrong. The truth is that foreign creditors have alternatives that America lacks. China can invest its trade surpluses in infrastructure across Asia, Africa, and Latin America through the Belt and Road Initiative. Japan can buy its own government bonds. Saudi Arabia can stockpile physical assets like gold, real estate, and strategic commodities. These alternatives don't perfectly replace Treasury securities, but they don't need to be perfect. They only need to seem safer than lending to a government whose debt grows faster than its economy. America, by contrast, has no easy alternatives. The U.S. government cannot function without borrowing multiple trillions annually. It cannot print money indefinitely without destroying the currency. It cannot cut spending or raise taxes enough to close the gap without social upheaval. The dependence is asymmetric, and asymmetric dependencies eventually get exploited. The contrarian insight is that this crisis is not coming. It's already here. The process of foreign creditors withdrawing from Treasury markets has been underway for years, masked by Federal Reserve purchases and temporary spikes in safe haven demand during various crises. The fact that interest payments now exceed defense spending while foreign Treasury holdings grow more slowly than new debt issuance represents a structural break that has already occurred. What most analysts present as a future risk has already become present reality. The mathematics don't work anymore, and increasingly, foreign finance ministers and central bankers can see that they don't work. They're responding the way rational actors always respond to deteriorating credit, by reducing exposure gradually enough to avoid triggering panic, but firmly enough to protect themselves when panic eventually comes. The $72 trillion shock isn't the size of U.S. debt. Official debt is $35 trillion, with additional obligations bringing total exposure towards $72 trillion when you include Social Security, Medicare, and other commitments. The shock is what happens when the world realizes that these obligations cannot possibly be met at current currency values. The shock is the repricing of American government debt from risk-free asset to risky sovereign obligation. History suggests this repricing occurs faster than anyone expects, triggered by events that seem unrelated until retrospect reveals their significance. Britain's reserve currency didn't end with a dramatic announcement. It bled out through balance of payments, crises, emergency loans, and grinding austerity that spanned 3 decades. The British didn't know they were watching an empire's financial death until it had already died. Americans face the same blindness today. The numbers are visible to anyone who looks. Foreign Treasury holdings declining as a share of new debt, interest payments consuming ever larger portions of revenue, the Federal Reserve trapped between inflation and recession. But numbers become reality slowly, then all at once. The question isn't whether foreign nations will stop buying U.S. debt. They already have begun. The question is, what happens during the decade-long transition as this new reality becomes undeniable? History is unequivocal. Reserve currency transitions have never occurred peacefully, cheaply, or without profound social and political convulsions, in the nation losing that status. The pattern has repeated throughout history, from Rome to Amsterdam to London. Now it's America's turn to discover whether it can break the pattern or whether the mathematics of empire remain as unforgiving as ever. The debt hasn't disappeared. It's been accumulating in silence, waiting for the moment when silence becomes impossible. That moment approaches not as catastrophe, but as a series of manageable crises that become less manageable each time. One day, perhaps soon, Americans will wake to discover that the financial architecture supporting their prosperity was far more fragile than anyone admitted. By then, the choice will no longer be how to avoid the shock, but how to survive it.